Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
All right, folks, you're on the Property Couch, your insider's guide to property investing. I'm Bryce Holdaway. He's Ben Kingsley. Mate, how are you feeling?
Oh, mate, $1 million. I was surprised that Bucks didn't pick me for last week Anzac Day clash. I would have potentially been a great sub. I would have lasted, well, actually, no, I wouldn't have even been able to get off the bench. I was still persisting with chronic back pain. So, we've got to keep talking to the surgeon and see what the problem is and see if we can get it fixed. But anyway, enough about me.
That's exactly. Well, I hope the surgery isn't what we have to do. But, mate, I think they went with Strawny instead of you at the Anzac Clash. So it was 50-50.
Yeah.
But today we're very lucky. We've got a special guest. We've got Bradley Beer, who's the managing partner or managing director of BMT and Associates, which is a tax depreciation specialist. And Ben, they have pretty much 80+% of the market. So these guys know what they're doing when it comes to tax depreciation. So welcome, Brad.
Great to be here, guys.
Now, we thought it was this podcast is all about giving our listeners the opportunity to get good quality information about property investing. And we thought the fact that you were in Melbourne, we were catching up with you this morning for other reasons, we thought it'd be a great opportunity to get you on and talk about a topic that you know a lot about, but perhaps listeners don't necessarily know how important it is. So I'm sure you get asked this question all the time. But mate, tell us, what's the benefit of getting a tax depreciation schedule done?
Benefit's really simple. Depreciation is a tax deduction for property investors. And what that does is give you more tax deductions, change the cash flow of that property. Effectively, what it means is more cash for property investors on the way through while owning properties.
And every property investor needs more cash. I've got a story back in 1999. I had a friend of mine who had a number of investment properties. Actually, it was 2 properties. He was living in Perth. His properties were in northern New South Wales. And for the first time, I remember that when the light bulb went on, in his eyes when he heard about a tax depreciation schedule being done. And at that time, you could actually backdate a number of years. And what we found is he went to BMT and actually got the depreciation schedule done for previous tax years. Went back to his accountant, and when he got a refund back, the amount of money was $15,000 that he used as a deposit to buy his next investment property. So it wasn't insignificant at all. But you probably see that all the time where people have left some stuff behind.
I've seen that many, many times, and we talk to people. It's almost, you get a bit excited sometimes when you talk to someone who hasn't claimed and didn't know anything, and you've owned it for 2 years. Oh, fantastic, yes, because they're really easy to help, because they don't get a deduction for the future years going forward. They actually go back to the tax office and get a cash back for what they didn't do in the past, and they're the exciting ones, I suppose. And I've seen $50,000 before. I've seen $187,000 once. A guy got back by amending his past for a couple of motels, but they weren't big motels. They just had lots of things in there to claim, and he hadn't been doing it.
I mean, that's an important point to make too, because if you enter into an arrangement with the tax office and you can't pay it and they give you a payment plan, they're going to charge you interest. But if they keep your money, they're not going to give you interest on that. So it's an imbalance there.
We're investing in property to build wealth. You really should just get all your money.
Yeah. So it'd be crazy for anyone who's serious about property investing to not explore getting a quantity surveyor's report in place. But can't your accountant do it?
The accountant, in the past, accountants often guess this, but the accountant doesn't estimate construction costs, and that's where the expertise of the quantity surveyor actually comes in. The numbers we come up with from a building and construction cost perspective will be accepted by the tax office. So the accountant also doesn't actually visit the property. So we actually visit the property, we see everything that's there, we find everything that's there, and then we're also accepted to estimate the cost of it, which is how the depreciation is calculated. So we come up with a number out of a bunch of numbers in the tax return for an investor. That number, that depreciation is important to get it right, get as much as you can, and we'll back it because we've seen it.
Mm.
I sort of look at it as a bit like a franking credit. I mean, if you look in the share market, and this is not tax advice by any stretch of the imagination, but if you think about it like this, when you've got a fully franked dividend that's getting paid to you, it means that the company's paid the tax, and that means that you don't have to, there's no double tax. Now, with depreciation, it's almost like saying, I'm going to get my dividend, but I'm going to have it unfranked, and so I'm going to have to pay tax on it. Whereas this is a way, in the property investment space where what we're talking about saying is, if you don't claim it, you're going to have to pay tax if you've got a positively geared property, or it's not going to, offset the savings that you're about to make from a cash flow point of view to roll out your portfolio.
And yes, especially it's just a lot of it's kind of education. It's almost like saying this property rents for $500 a week, but you know what? You can have it for $400 because I like you, and I didn't know it was worth $500. That's the way you could compare it in something that people will probably understand a little bit better.
Yeah, and you're not penalising your tenant. I mean, they're still paying fair market value for that. What we're actually saying here is, in any business, the assets that we run in the business have a usable life, and that usable life allows us to do a depreciation program on it.
Yeah, things are just wearing out over time. Now, I mean, you're claiming depreciation on these things. The carpet is going to wear out one day. You're going to have to replace it.
Yeah.
The fact is that you're going to have to replace it anyway. You might as well claim the deduction on the way through if you can.
Yeah. I mean, again, or what are we doing? We're paying more tax than we need to. And I mean, wasn't it Kerry Packer who once said at that famous Senate inquiry, he goes, something along the lines of, I'm not an idiot, I'm not avoiding tax, but I'm certainly going to pay, I'm going to make sure that I'm paying the minimum that I can. And so he has people around him who are able to help him do that. And we're not talking, about double Irish sandwich, with a Dutch, Dutch ingredients or whatever the sort of saying is at the moment in this whole big debate around Google and all of this tax being paid offshore. What we're saying, mum and dad investors talking about residential property, saying to ourselves that there could be in the vicinity of $8,000, $10,000, $15,000 a year that we can add as a cost base, which reduces against the income that we earn, which we then get an offset benefit against from a tax point of view.
And look, the rules, people sometimes say to me, look, how long's this been going on, when they find out about it? And I mean, the answer's really simply in the legislation. It's kind of a bit boring to go and read it up, but there's simple legislation that says these depreciation rules are there. The fact is it's not very well understood by the property investing public, like a lot of things about investing in property. Mm-hmm. Education is the key to lots of things about investing in property, and depreciation is one of those things that's probably at the lower end scale of people finding out before they jump in and buy something.
Now, Brad, there's a significant date for you. It's around 1985. For the benefit of our listeners, can you sort of expand on that a bit?
Look, the significant date really is now in 1987. Okay. What that is a date where if a property's been built after that date, you actually get to claim a percentage of the structure of the building. In 85 it was there, but they've run out because it was different percentages. But 87 onwards, if it's been built after that or had a lot of work done to it after that, we get to claim 2.5% of the structural cost of the actual building. Now, a lot of people think that this 1985 and 1987 means if it's older than that, we don't get to claim something. That's actually not correct either. You don't get to claim something on the actual structure of the building, but you still get to claim on the other things like that we call, or the tax office calls, plant and equipment. And these are things like carpets, hot water services, stoves, things that don't last as long and probably have been replaced since 1985 or 1945 when the house may have been built. So when you're buying a property now, yes, that date's important because that means more deductions. But we're also looking at, well, what else has been done to the property and the condition of all of these plant and equipment items that are in that property and what sort of value have they got. Now, if your carpet's been put there 100 years ago, I'm not going to be able to put a value on it. There's no depreciation on that carpet, but it's been replaced, I hope, since then. And the hot water services have been replaced at some point. And when you start asking some questions about someone's property that's built before, oh no, it's before 1985, you get this, oh, what about the hot water service? Oh no, that's only a couple of years old. And these things have value and there's still depreciation there.
That's a question we often get asked by clients because Ben and I are on record as saying we favour established properties for clients, but we're buying, if it's a house, it's, quite often we're chasing a period home built in, 1910, or if it's an apartment, if it's not a deco, it's a 70s block that's, 60s, 70s block. And that's often the first question that a client would say is, we're not going to get the depreciation we want, but you'd refute that.
And the answer is, sometimes you're not going to get quite as much, but you're still going to get depreciation. The period homes that you guys often buy for the clients have often had extensive renovations, lots of money being spent, often by people who did this as their family home probably, and therefore they probably spent more than an investor would spend, made them into really nice period homes, and therefore more money's been spent on renovations means more depreciation. So the more of that's been done, the bigger difference that makes. Definitely old property still gets it, especially when it's been renovated.
Yeah, look, the challenge with some depreciation from a technical point of view is that every property is unique. So when, you've heard Bryce and I talk about building out a plan and planning to become what you plan to become, and part of the modelling work that we do in our day-to-day business is around sort of understanding cash flows and when the next appropriate purchase is to be made. So, Brad, is there any sort of rough rules of thumb that people can use as a guide that will help them sort of say, okay, I've got a certain value and at a certain age point, is there something? I mean, I know you've got a great calculator on your website, bmt.com.au.
bmtqs.com.au.
qsquantitysurveyors.com.au. That's, an important one where people can actually put some rough estimates in there and they get a guide. And that guide's really important because effectively what we're talking about there is when you calculate a gross rental yield, you're calculating it based on your holding costs and the rent that you're receiving. Now that means that at some point in time there's a net outcome, so there's a net yield that you're getting there. With regards to to adding that depreciation back through, that can improve that net yield, can't it, Brad?
Yes, because it's once this depreciation is claimed, it actually makes a difference of based on your tax rate, X dollars per week to your after-tax position on this property.
Yep.
So it is like your rent or your interest. It's another one of these things that makes a quantifiable dollar difference.
Yep.
Now the calculator is good. It gives you a rough number to work with. But when you've looked at a number of properties, or when especially if you're probably looking at a period home with a lot of renovations, it might be even better to actually use it first on your basic numbers. You're getting a bit closer, then go, let's talk to the guys at BMT and we'll actually talk through the property with you so what's been done. It's a period home. What's been spent? What things have been done to this property? Show us the photos, show us the link, and give you a better indication based on us actually looking at that property that's actually had some changes to it. And we'll be able to give you a range over the phone. It doesn't cost anything.
Yep.
Of what sort of deductions will be there.
Fantastic. And I think that comes back to the point that Bryce and I and what this whole podcast is about. It's about highlighting to people the intricacies that are involved in property investing and, again, the specialisation. This is money wealth that we are talking about. So we're talking about your financial well-being. And here's another example of a team of specialists who can come in and improve your financial well-being. And it's all part of building that great investment team that can work with you on your journey. I mean, big businesses do it. So we as investors need to understand that we're in the business of property investing. And whilst being in the business of property investing, we've got to have an honest conversation with ourselves about how much do we know? And if we don't know enough, we need to lean on the experts to be able to get that information to make smart decisions that are going to create wealth for today and tomorrow.
Yeah. Now, Brad, one of the bugbears that Ben and I have, and we talk about it all the time, is we get really annoyed when someone makes a purchasing decision purely for depreciation reasons. And despite the fact that's core business for you, we think if you get the other stuff right, then you have the conversation about depreciation. That's the way that we think that should unfold.
It's more negative gearing. Yeah, that's probably the bigger part of it.
Having a tax outcome is your primary thing.
Correct.
But so we love depreciation. I'm a degree qualified accountant, so I love depreciation on my properties as well. But if someone was to think about location and quality of asset first, location, quality of asset first, and then depreciation second. If they were thinking that maybe they'll buy a more established property, and then in 2 or 3 years' time they will renovate it, I always say to them, you can create your own depreciation rather than buying it. And there's a bit of a rule, and I'm not sure how much you can talk about it today, but if someone was to get a depreciation schedule done for that early part of the investment property and then renovate it later, they can actually claim more depreciation in the year that they'd actually do the renovations. Is that right?
That's correct. I agree with you on depreciation not being the prime reason behind a decision. The only time I think about that is if you're looking at two houses next door to each other, and one's built prior to that special 1985 and one's built after that 1987, you know, if all things were equal, you'd choose the newer one. Now it's probably got less maintenance and things as well, but the rest of the overall wealth out of that property is the decision number one. Back to the renovations. It's a regular question, one that should be asked. Depreciation and renovations is what it really comes down to. You've bought this property, you've had it for, let's say, a couple of years, and you've rented it out, and then you decide to do some renovations. You want to build the equity, revalue, whatever you want to do those renovations for. What you've bought at the start is a property with things in there that had some sort of value. So old property still gets depreciation, we touched on. So the fact is, even though it was old, you should have got a depreciation schedule or looked into it to make sure it was worth it. And you've got a depreciation schedule. These things are depreciating away. And I'm using the word depreciation made too many times. Depreciating away. And then when you renovate, if it's that next year or year after, you throw these things away. So instead of continuing to depreciate, you've actually thrown them or scrapped them, I suppose you'd say. Whatever value is left on those things is an instant deduction for whatever is left. So rather than claiming it over the next 5 years, 7 years, you claim it all straight away because you've thrown it away, you've scrapped it, you're no longer using it in this investment property.
So it's a lump sum scrapping, basically.
Lump sum scrap of whatever the residual remaining value is in that financial year. So if you throw a few of these things away, it can be $5,000, $10,000, instant deduction for the scrapped amount of value on these things sometimes.
So plus the new stuff that you do. Yeah, that's a huge bit of gold right there.
Yeah. And then as a renovator, there's also the after. So you've spent more money on these things, you've renovated, it might be part of the building, it might be the kitchen, it might be the stove, whatever it actually is, you've spent more money, so you've now got more things that are there to depreciate. The important thing about that overall is probably the question is, I'm going to renovate it, so I'll do a depreciation schedule after that, is what I often hear. Call the quantity surveyor in to have a look at it first, because otherwise you're just throwing away or scrapping potentially a bunch of money and not getting anything for it.
Well, it goes back to your statement before about Kerry Packer saying if you don't do everything you can to minimise your tax, you need your head read. So that's a classic case.
Tax avoidance is illegal, but even tax avoidance or evasion, or it's illegal. I mean, it's written into the tax law, but certainly minimising tax isn't. Yeah. And managing your investment portfolio as a business certainly isn't as well. I'll give you a quick example for me, because again, these podcasts are about good sharing of information. About 2001, I bought a semi in Alexandria in Sydney. It's been a fabulous investment for my wife and my family. And when we went and saw the accountant in Sydney, this was before, obviously we knew about quantity surveyors and specialists who were doing this, because I was still a novice back in the day. He just said, it's an old property, what's happened to it? And I said, the kitchen's been done, there's probably been a good renovation out the back. And he said, look, we'll do some rough estimates. Now, I'm one of those statistics that, Brad, you might want to mention that I heard Brad say earlier today that 80%, they've done some research, and 80% of people aren't getting the full deductibility from the claims that they put in. So I'm a classic example of that, where I had a property that I was depreciating, but I wasn't getting that maximum benefit. So I've probably done myself out of, maybe $5,000, $10,000, $15,000 worth of deductions. And obviously I don't work with that accountant anymore, and we use obviously BMT to do all our depreciations.
And that's the regular story. Now people are getting a little bit better and a little bit more educated. These things help that. But we did actually go and have a look at a large number of, what are you claiming on this property situations? And we found 8 out of 10, actually we could find more deductions for them. So And they've a lot of the time been that scenario. Someone, whether it's their accountant or someone else, has said to them, "Well, you know, it's old. You know, it doesn't," or they don't know the real rules, the real ways that depreciation actually works. It's old. There'll be no deductions. The myths that I hear every day cost investors money, and we help to change that.
Right. Well, there you have it, folks. Our mission is to bring you the insider's guide to property investing, and there we have just spent 20 minutes with Bradley Beer, who is someone who's an expert when it comes to depreciation, tax depreciation. So what we've asked Brad to do is give us a copy of a case study, a couple of case studies, so you can actually see what happens if you don't, for some of those stories he talked about where they haven't received any depreciation, and then of course once they have had some depreciation. So if you go to thepropertycouch.com.au and go under episode 10, tax depreciation, you'll be able to get a copy of that. And of course, if you want to leave us a review or leave us a question for a future podcast, we'd certainly encourage you to do that. But 20 minutes flies, Brad. We certainly appreciate you coming in today. And just for our listeners' sake, this is not a paid advertorial or anything. We are friends with Brad. We've known him for some time. If we've ever got a question ourselves regarding depreciation, we go to him. So,
and if I can add, the reason why we've brought Brad in is because we do personally use BMT. Again, this is not a paid, sort of pitch. It's just about saying great service, great expertise, and that's what you're looking for. In our industry, it's littered with half-baked, jerry-built instead of Clive-built type operators. And what we're trying to say to you is that if you're going to work with a professional, understand their criteria, understand the skill sets behind them, have a look at their history of business and what they're doing, because you want an A team. You don't want a B team, because with the A teams you're going to get the best results.
So as we wrap this up, Brad, would you say quite simply, if someone doesn't get a depreciation schedule, they're just simply throwing money away?
Absolutely. And if there's any reason why their particular property doesn't have a whole lot of depreciation, ask the question anyway. Listen to the expert that will know whether it's going to or not.
There you have it, folks. There's your insider's guide to property investing. If you go to our Facebook page, go to Instagram and follow us on Twitter, we'd certainly love to hear from you. And again, if you've got any questions that you'd like us to cover in upcoming podcasts, feel free to leave that at propertycouch.com.au. Thanks again, Brad, for joining us. And Ben, until next week.
Arrivederci.
See you, folks.